Imagine a storm brewing over Britain's economy, one that's got bond traders on edge and the Chancellor sweating bullets ahead of the Labour Party conference. We're talking about skyrocketing bond yields, a debt burden that's ballooning faster than anyone expected, and an inflation monster that's refusing to go back in its cage. If you're feeling the pinch in your wallet from higher interest rates or wondering why your savings aren't growing like they used to, you're not alone. Today, let's unpack the UK's fiscal mess, why our gilt yields are the highest in the G7, what's causing it, and why it's time for some bold moves to turn this ship around before it hits the rocks. Let's start with the basics. British 10-year bond yields, or gilts, have shot up to 4.8% recently, a massive jump from just 0.2% back in 2020. That means the government is paying through the nose to borrow money. Over £111 billion in interest payments this fiscal year alone, which is more than we spend on education. It's like your credit card bill exploding because lenders think you're a risky bet. And compared to other rich countries, we're leading the pack in the wrong way. Higher yields than the US, France, or anywhere else in the G7. Opposition leader Kemi Badenoch is pointing fingers at Chancellor Rachel Reeves, calling it economic mismanagement. And yeah, there's some truth there. But it's not the whole story. This is a cocktail of homegrown problems mixed with global headaches. First up, inflation is the big villain here. Prices rose 3.8% in the year to August, way above the Eurozone's 2%. The Bank of England has kept interest rates at 4% to fight it, over 1.5 points higher than the European Central Bank's rate. That keeps short-term yields high, but the real damage is to long-term confidence. After our recent inflation surge, people are betting it'll stick around. A YouGov/City survey shows Brits expect 3.9% inflation in 5 to 10 years. If everyone thinks prices will keep rising, lenders demand higher returns to protect their money, pushing those long-term yields up. It's a vicious cycle. Higher expectations mean higher rates, which could make inflation even harder to tame down the line. Then there's the global side. Capital's getting scarce everywhere. Governments around the world are borrowing like crazy, even stingy ones like China and Germany. Add in the AI boom sucking up trillions in private investment, and suddenly there's a worldwide scramble for cash, driving up real interest rates. Britain feels this pinch extra hard because we're flooding the market with gilts. The Treasury's issuing more debt, and the Bank of England is aggressively selling off the bonds it bought during past crises, unlike the Fed or ECB, who are just letting theirs mature. In the old days, domestic pension funds would snap these up, but with final salary schemes winding down, those funds are shrinking their holdings. Now, overseas investors own the lion's share, and they're flighty, sensitive to every global twitch. The Office for Budget Responsibility reckons this shift could add 0.8 percentage points to yields over time. The Treasury's trying short-term debt to ease the pressure, but it's just a band-aid. Of course, the third piece is fiscal policy itself, and this is where Reeves has some control, but she's fumbling it. She's promised to slash the deficit from 4.8% of GDP last year to 2.1% by 2029 to 30, but markets aren't buying it. Her plans hinge on ditched welfare cuts, assuming low borrowing costs, and pie-in-the-sky productivity boosts that no one believes. Analysts at Capital Economics say there's a £28 billion hole way more than the £9.9 billion she's set aside, meaning big tax hikes or spending slashes are coming, compared to America's 6.1% deficit with no fix in sight, or France's 5.5% amid political chaos. Britain's numbers look manageable, but we're more exposed in a crisis. No ECB safety net like France, no dollar dominance like the US. Plus the ghost of Liz Truss's 2022 mini budget fiasco, with its unfunded tax cuts sending yields soaring, has markets on high alert. One whiff of fiscal slip up and boom, yields spike. This isn't just numbers on a screen, it's hitting everyday Brits hard. Higher borrowing costs mean pricier mortgages, squeezed businesses, and less money for public services. Debt interest gobbling up more than education spending. That's a choice we're making by default, starving investments in schools, roads, or tech that could actually grow the economy. And with global trends like AI demanding capital and governments everywhere piling on debt, ignoring this could spark a bond crisis that leaves the UK isolated and reeling. We've seen investors worry about rich countries' unsustainable debts, and Britain's high yields are a warning sign we're not immune. So, what's the way out? It's time for a bold decision in November's budget, one that doesn't just tinker around the edges, but resets the UK's fiscal path for stability, agility, and real productivity gains. Here's my take. Reeves should announce a productivity pact, a radical overhaul that ties fiscal discipline to smart growth. Start by committing to ironclad deficit reduction through efficiency audits across government, cutting waste without gutting essentials. But don't stop at austerity. Pair it with bold incentives like tax breaks for R&D in AI and green tech, fast-tracking infrastructure projects by slashing red tape and reforming welfare to reward skills training and work. To supercharge agility, create a national agility fund funded by selling off underused public assets, investing in digital education and flexible labour markets. This isn't about short-term pain for no gain. It's signalling to markets that Britain's serious about sustainable finances while unleashing productivity to outpace inflation and attract stable capital. It could lower yields by restoring credibility, free up billions for growth, and position the UK as a nimble player in a capital hungry world. Think about it, countries that adapt win. If we keep preparing for the best case scenario, like falling inflation magically fixing everything, we'll neglect the risks and pay dearly. But a bold move like this, Productivity Pact, could protect us from global shocks, boost economic output, and make Britain more resilient. It's not easy. MPs will lobby, lobbyists will whine, but ignoring the consequences of high yields and shaky finances isn't an option. The bond market's watching, and so should we. Let's push for decisions that build a stronger, more agile economy for all.